Welcome to the Deep Dive. Today, we're plunging into the fascinating, often hidden world of anti-money laundering, or AML, laws in the European Union.
It's quite a journey.
It really is. Our mission today is to give you a shortcut to understanding this complex legal landscape. It's filled with surprising facts and hopefully some aha moments about how the EU is trying to make our financial system safer for you. We'll be uncovering the constant evolution of these laws, from their pretty humble beginnings right up to the cutting-edge future.
And revealing how each step was really a strategic move, often reacting to closed loopholes as criminals relentlessly adapted their tactics.
Before we dive into the EU's specific steps, though, you mentioned the global context is key.
Absolutely. It's crucial to understand the global forces that really push the EU into action.
Yeah.
Money laundering wasn't just an EU problem. It became a massive global crisis in the late 20th century.
Right.
Think about the 1980s. The explosion of drug wars, powerful cartels like Medellin, figures like Pablo Escobar, all generating immense illicit wealth.
Just huge amounts of cash needing to be cleaned.
Exactly. And this forced an international reckoning. That pressure led directly to the 1988 Vienna Narcotics Convention, a critical moment that put a global spotlight on the need to actually criminalize money laundering itself.
Okay.
And then, almost immediately after, the G7 countries established the Financial Action Task Force, or FATF, in 1989. Their standards became the blueprint, really pressuring nations, including those in Europe, to build serious defenses.
That broader historical context is definitely key. So with that global push as a backdrop, what was the EU's very first move? Back in 1991, how did they start cracking down on dirty money within their own borders?
So the first directive, enacted in June 91, was truly foundational. Its primary focus was simple, relatively speaking: bring banks into the fight.
Just the banks?
Primarily, yes. It mandated that money laundering be recognized as a criminal offense across all member states, which, believe it or not, wasn't universally the case before. And crucially, it introduced core concepts we still talk about today, like know your customer, KYC, sometimes called customer due diligence, or CDD.
Like checking IDs at a club, essentially.
Kinda, yeah. Banks had to verify the identity of their clients, understand their business. They also had to keep detailed records of accounts and transactions for up to 5 years.
And reporting anything suspicious?
Yes, that was the other key piece. If a banker spotted something truly unusual, a huge deposit with no clear origin, they were obligated to file a suspicious activity report, or SAR, with national authorities.
So a significant first step for its time, definitely groundbreaking. But it sounds like it created a very clear target. Where did it fall short? How did criminals adapt?
Precisely. The rules were limited almost entirely to traditional banks, and this left glaring vulnerabilities.
So criminals just went somewhere else?
They did. Being adaptable, they quickly moved their illicit funds through non-bank channels. Yeah. We're talking cash couriers, informal money exchangers, maybe even seemingly legitimate businesses that weren't subject to the same scrutiny. This glaring loophole meant that while banks were getting covered, a vast swath of the financial ecosystem remained wide open for exploitation.
Okay, here's where it gets really interesting. Fast forward to 2001. The world had changed profoundly, obviously, especially after 9/11. The nature of financial crime seemed to evolve new threats, like terrorism financing, more sophisticated fraud. How did the second directive respond to these new challenges and those vulnerabilities?
The second directive in 2001 was a really dramatic response. It was driven by the realization that criminals weren't just using banks, they were leveraging the very legal and accounting structures meant for legitimate business.
Okay.
So this directive significantly expanded who was considered an obliged entity. It went way beyond just banks.
Who else got pulled in?
It now included lawyers, accountants, auditors, tax advisors, notaries, and other legal professionals, although under specific conditions, mind you.
So if you were setting up, say, a shell company using a lawyer.
Exactly. That lawyer now had a responsibility, a legal obligation, to truly know who you were and the source of your funds. KYC applied to them too.
So it wasn't just about expanding a list, but about understanding a deeper pattern, how criminals were actually operating.
Precisely. It also broadened the definition of predicate offenses, the crimes generating the dirty money. It wasn't just drug trafficking anymore.
Right.
It now included a much wider range of serious crimes like corruption, fraud, organized crime. So hidden money from bribery or large-scale cybercrime was now explicitly covered.
And the SARS.
The directive also explicitly required those SARs to be sent to National Financial Intelligence Units, FIUs. These are the critical national nerve centers, like data banks for suspicious financial tips, analyzing and passing info to law enforcement.
Okay.
And importantly, it extended rules to non-banks, like money transfer services, think currency exchange kiosks, remittance agencies, finally closing that initial loophole left by the first directive.
That's a massive expansion. Can you give us a concrete example? How would this have actually stopped something that the first directive missed?
Certainly. Imagine a gangster using a seemingly legitimate but ultimately fake law firm to funnel drug cash.
Okay.
Under the first directive, that law firm itself wasn't directly scrutinized in the same way a bank was. But with the second directive, that law firm now had a legal obligation to do KYC on its clients and report strange payments.
Got it.
This directly targeted and significantly closed a major channel for money laundering that criminals had been exploiting pretty widely.
Okay, so by 2005, the EU seems to realize that this kind of rigid, one-size-fits-all approach maybe wasn't the most efficient way. How did the third directive introduce a shift towards maybe flexibility, and what new focus did it bring?
You're spot on. The third directive, enacted in 2005, kept all the previous rules but added a crucial innovation: the risk-based approach, or RBA.
Risk-based approach, what does that mean in practice?
It was basically a recognition that not all transactions or clients pose the same level of risk. It seems obvious, maybe, but it was a big shift. So financial institutions and businesses could adjust the rigor of their checks based on that risk assessment.
So lighter checks for some, tougher for others?
Exactly. For low-risk situations, let's say a local student opening a basic bank account, they could apply simplified due diligence, SDD, allowing for lighter checks.
Makes sense.
But for high-risk scenarios, maybe a politically exposed person, a PP, or someone dealing with a high-risk country, they had to apply enhanced due diligence, EDD. That meant much stricter scrutiny, deeper investigation into the source of funds and wealth.
So it's about smart filtering, not just applying the same heavy rules to everyone, allocating resources better.
It truly is like airport security, Everyone goes through, but maybe passengers flagged as higher risk get extra screening while others get faster checks. The third directive introduced that kind of intelligent, risk-stratified filtering to AML.
Smart. What else did it do?
It also explicitly added measures against terrorism financing, right alongside general financial crime, reinforcing that post-9/11 focus.
Okay.
And critically, for the first time, clear penalties, significant fines, other sanctions were introduced for non-compliance. This gave the rules real teeth.
Consequences.
Yes. And it expanded the covered industries again, bringing in non-financial businesses like casinos and other gaming sectors, which were, unfortunately, pretty well-known hotspots for money laundering.
Right, casinos are classic examples. Okay, this evolution seems like a constant game of pulling back the curtain on hidden money. How did the fourth directive, around 2015, take this even further, really trying to uncover who truly owns what?
That's precisely the aim of the fourth directive. It fundamentally strengthened transparency, making a massive stride in tearing down those corporate veils used to hide ownership.
How? What is the mechanism?
Its most impactful measure was mandating that every EU country set up a central register of ultimate beneficial owners, or UBOs, of companies.
UBOs, that term comes up a lot. What exactly is that?
A UBO is the real, natural person, an actual human being, who ultimately owns or controls a business. Typically, it's defined as anyone owning 25% or more, or having significant control in other ways.
So finding the puppet master behind the company.
Exactly. It's about identifying the individual who holds the true economic benefit or decision-making power, no matter how many layers of shell companies might be involved.
That sounds huge for transparency.
It was. It also lowered the threshold for reporting large cash transactions again, down from 15,000 euro to 10,000, recognizing that cash is still a primary tool for illicit money.
Still tightening the screws.
Yes, and the definition of politically exposed persons, PEPs, was expanded. It now explicitly included domestic politicians and their families, not just foreign officials, requiring banks to apply that extra scrutiny to their accounts too.
Interesting.
And finally, it brought real estate agents fully into the AML net, alongside all gambling and gaming firms, even the smaller betting shops. Plus, it aligned EU laws more closely with the updated international FATF recommendations from 2012.
Okay, then came the Panama Papers scandal, which really threw hidden wealth into the spotlight globally.
A massive shockwave.
And at the same time, we saw the rapid rise of cryptocurrencies, creating entirely new challenges. How did the fifth directive around 2018 tackle these really modern issues head on? How did it drag the AML framework into the digital age?
The fifth directive was a direct and frankly urgent response to those specific emerging challenges. The Panama Papers highlighted the UBO issue, and crypto was exploding.
So what did it do about crypto?
For the very first time, it explicitly brought cryptocurrency exchanges and custodial wallet providers, basically, the crypto world's equivalent of banks under AML rules.
Finally.
Yes, requiring them to conduct KYC and report suspicious transactions. So if you wanted to buy Bitcoin on an EU exchange, suddenly you had to prove who you were, just like opening a regular bank account.
That's a major change for the crypto space.
Huge. It also tightened rules on prepaid cards, another common tool for sort of lower-level money laundering. It lowered the limit to only €150 without needing ID, and required ID for online transactions above 50.
Pilsing even those smaller but persistent loopholes.
Exactly. And perhaps most notably for transparency, it removed the legitimate interest barrier for accessing those UBO registers we talked about.
What does that mean? More public access?
Yes. It meant those central registers became far more widely accessible. Journalists, citizens, other companies doing due diligence, they could access the information more easily to investigate suspicious entities. A big win for public accountability.
Definitely.
Furthermore, it mandated extra checks on clients coming from high-risk jurisdictions, countries identified as having weak AML laws. And it gave more power to the national FIUs to request information, specifically including things like crypto wallet identifiers and transaction details needed for investigations.
More tools for the investigators.
Right. And one more thing. Member states were also required to set up centralized bank and payment account registries to make tracing money across borders easier for authorities.
Okay, so we've got the digital world somewhat covered, transparency boosted. But what about making sure the punishments actually fit the crime and ensuring everyone's playing by the exact same rules across the entire EU? What did the sixth directive bring to the table around the same time?
Right. The sixth directive, also adopted in 2018 and implemented by 2020, was really focused on standardizing and harmonizing the criminal law aspects across the EU. It aimed for consistency in enforcement and punishment.
Oh, so?
Well, it expanded and standardized the list of predicate offenses, those underlying crimes, generating the dirty money, to a common list of 22 categories across all member states.
Okay.
And importantly, it explicitly included newer areas like cybercrime and environmental crime. So if money originated from illegal toxic waste dumping or a major ransomware attack, laundering that money was now unequivocally punishable EU-wide under the same definitions.
So no more arguing about whether this specific type of crime counts.
Exactly. Leveling the playing field. A major strategic step was also introducing corporate liability. This means companies themselves, not just individuals, can now be held criminally responsible for money laundering committed by their employees or owners if supervision was lacking.
That shifts the responsibility significantly right onto the entity itself.
Precisely. It also criminalized aiding and abetting money laundering more clearly, ensuring that those who knowingly assist in hiding dirty money, lawyers, accountants, anyone facilitating, could face prosecution even if they weren't the primary launderers.
Closing the net on facilitators, too.
Yes. And it mandated higher minimum prison sentences for money laundering convictions. For example, increasing the minimum potential sentence for serious cases from maybe 1 year up to at least 4 years, along with stiffer potential fines.
Upping the state.
Definitely. And crucially, as I mentioned, establishing common definitions of money laundering across all member states. This is vital for making cross-border cases work smoothly and encouraging closer international cooperation between EU police and prosecutors. This directive really aimed to ensure that wherever you are in the EU, you face the same clear rules and potentially severe punishments.
So after decades of building this layered defense, directive after directive, the EU took what sounds like its biggest, most ambitious step yet just recently in 2024. Tell us about AMLA, the Anti-Money Laundering Authority. How is this fundamentally changing the game?
The creation of AMLA, the Anti-Money Laundering Authority, finalized in May 2024, is genuinely a monumental shift. It marks a move away from decades of a fragmented system.
Fragmented how?
Well, you had 27 different national regulators, 27 FIUs, all applying EU rules, but sometimes interpreting or enforcing them slightly differently. This created inconsistencies, potential weak spots, what some call forum shopping by criminals looking for the easiest jurisdiction.
Right, finding the weakest link.
Exactly. AMLA changes that by acting as a central, unified coordinator and supervisor. It'll be headquartered in Frankfurt, set to start initial operations in 2025 and be fully up and running by early 2028.
And what's its job exactly?
Its mandate is incredibly significant. First, AMLA will directly supervise up to 40 of the largest, most complex cross-border financial institutions, think the huge banks, big crypto providers, operating across many EU countries.
Direct EU oversight for the biggest players.
Yes, providing consistent, centralized supervision instead of relying solely on varied national approaches for those entities.
That sounds like it could streamline things for those big institutions, maybe less confusion.
Potentially, yes. More consistency, at least. AMLA will also play a crucial role in coordinating the national FIUs, helping them share intelligence and data more effectively to spot EU-wide money laundering schemes, especially in complex areas like crypto.
So connecting the dots across borders.
Precisely. And critically, AMLA will be responsible for drafting common rules and detailed technical standards, what's being called the single rule book that all obliged entities across the EU must follow.
A single rule book, finally cutting through that fragmentation.
That's the core idea. And it will also indirectly oversee the national AML supervisors to ensure they're enforcing the rules correctly and consistently across the board.
So what does this mean for, the average person, the citizen?
For you, the citizen, AMLA should, in theory, make the financial system significantly safer and more secure. By clamping down more effectively on money laundering and terrorist financing through this unified approach, it helps protect everyday savers and taxpayers. As German Finance Minister Christian Lindner put it quite well, honest citizens and honest business people are hurt when clans and mafia are able to launder money on a grand scale. AMLA aims to stop that.
A stronger shield for the legitimate economy.
Okay, so looking ahead now, towards 2030 perhaps, how is the EU planning to leverage all this rapidly advancing technology to stay ahead of financial criminals? Because let's face it, the criminals are using tech too. What's on the horizon in this ongoing arms race?
Yeah, the future of AML in the EU is intensely focused on technology. It's both a huge opportunity and, frankly, a massive challenge.
What kind of tech are we talking about?
We're talking heavily about artificial intelligence, AI, and what's known as subtext supervisory technology. Machine learning algorithms can scan millions, even billions of transactions in near real time, flagging complex patterns that no human analyst could ever realistically detect.
Like what kind of patterns?
For instance, AI might identify a series of individually small, seemingly normal transfers across multiple accounts and borders that, when viewed together, strongly suggest a sophisticated layering scheme designed to obscure the origin of funds. Many tools like this are already being deployed, constantly improving data quality and risk detection capabilities.
So moving beyond just reacting to SARS. Exactly. The vision is pushing towards real-time monitoring, aiming for almost instantaneous reporting and analysis of suspicious transactions. The idea is to dramatically reduce the time it takes to identify and potentially shut down money laundering operations as they happen, not just after the fact.
Wow, real-time monitoring sounds revolutionary. But getting that kind of instant data flow across 27 countries, that must be a huge hurdle.
It's a critical challenge, absolutely. There's a major push for enhanced cross-border data sharing, with AMLA and the FIUs investing in secure, interoperable platforms for instant intelligence flow. Think of it like police forces finally having seamlessly synced databases for financial crime across Europe.
At the hurdles.
The hurdles are significant. Coordinating 27 different legal systems, overcoming technical incompatibilities, ensuring robust data privacy and security, and just building that fundamental trust needed for seamless sharing between jurisdictions. It's a massive undertaking.
What about crypto and blockchain tech itself? Is that just a problem, or can it be part of the solution?
That's a really interesting area. Authorities are exploring blockchain and distributed ledger technology, the tech behind crypto, not just as a challenge, but as a potential tool. Since many blockchain transactions are publicly recorded, they're investing heavily in chain analysis techniques to trace illicit funds on the blockchain itself.
Using the transparency of the ledger against the criminals?
To some extent, yes.
Yeah.
And as crypto evolves, new analytics tools are constantly being developed to spot laundering in digital assets. Of course, the challenge is that criminals are also using advanced tech things like AI for deepfake identities to fool KYC checks, or sophisticated crypto mixing services to obscure transaction trails.
So it really is an arms race.
It absolutely is. And finally, on the business side, we'll see more RegTech regulatory technology. That means more automated compliance tools for banks and other obliged entities. Things like secure digital IDs to streamline onboarding, AI chatbots for initial risk assessments. tools to reduce the compliance burden while hopefully increasing effectiveness.
It sounds incredibly complex. What do you see as the biggest overall challenges and maybe the biggest opportunities that lie ahead for the EU in this tech-driven fight against financial crime?
The challenges are immense, no doubt. Coordinating 27 distinct countries, even with AMLA, is inherently complex. Training thousands of supervisors and compliance staff in these new technologies is a huge task. Upgrading often old legacy IT systems in both the public and private sectors costs billions.
And keeping up with the criminals.
And constantly keeping pace with criminal innovation, like their use of encrypted messaging apps or those crypto mixers we mentioned. Plus, there's the constant balancing act of ensuring privacy and data security while enabling the necessary surveillance and data sharing. That's a fundamental tension.
But the opportunities must be significant too.
Absolutely. The biggest opportunity is finally eliminating that weakest link problem through AMLA and the single rulebook, creating a more consistently strong defense across the entire union. The potential for significantly increased penalties and genuine corporate accountability is another major plus.
And the tech itself.
And the technology, despite the challenges, offers the opportunity for dramatically improved detection rates through shared intelligence databases and those advanced AI tools. The EU's ambition here is quite clear. They aim to become a global model in AML-CFT, setting a gold standard for how to tackle financial crime effectively in the 21st century.
So wrapping this all up, what does this journey mean for you, the listener? We've gone from basic bank checks back in the 90s all the way to AI-driven real-time monitoring and this powerful new EU authority, AMLA. This deep dive really shows a constant strategic evolution.
It really does.
The EU's AML framework is a clear testament to this ongoing process of adapting, refining defenses against financial crime, constantly trying to close loopholes and enhance transparency in what's clearly an ever more complex financial world.
And this whole journey, this constant evolution, raises a really important question for the future, something for you to think about. As technology continues its incredible pace of advancement, and as the EU pushes hard for this truly unified AML system, what new forms of financial crime do you think will emerge next? And maybe more importantly, how do you imagine our regulators, our defenses, might stay that crucial step ahead of them?
It's truly a complex and ever-changing landscape out there, demanding constant vigilance and innovation from both sides. We encourage you to reflect on these ongoing challenges and this continuous drive to make our financial systems and ultimately our societies safer.